आपण सुरू करायचं सेशन. ऑलरेडी 12 मिनिटं झालेत. नाही, कोणी जॉईन तर नाही केलेलं अजूनपर्यंत. काय म्हणाला? हो, ते YouTubeवर टाकलंय मी. लाईव्ह रेकॉर्ड होतंय ते. ओके. सो लेट मी शेअर. Share window, not window. Okay, not entire screen, but all right. So this session would be in English, okay? And I hope you are able to see my screen. Can anyone confirm? All right. Okay. So the agenda for this session is uh, as this is a recap session, right? We will quickly review whatever we have covered, and then from next session onwards, we will have risk management as well as derivative segment. So derivative segment consists of futures and options. That would be in a later stage. So today we will look at what exactly are the benefits of trading stocks, risk associated with it, how to trade those stocks. There are different types of indices, and what are those indices, what is the significance of those indices. Then previously we covered technical analysis, where single candlestick pattern, multiple candlestick patterns, those are basically Japanese candlesticks. And in a little moderate level, say supports and resistances, volumes, what are different types of patterns which are getting generated when different trades are occurring, and then Dow theory as well as market phases. And then we will see what is the next agenda in the next session. Give me a moment. I hope I want to see if there is anyone pending. Okay. All right. So this session, I want to wrap this session by 10 p.m. So we have around 45, say 40 to 45 minutes. And if you have any question, please stop me on that slide, and I will cover. I will try to answer the question that you have. So, what exactly is a stock, or many people call it as an equity, right? So, if there is a business and that business owner wants to have funding, and that funding could be because of business expansion, customer requirements. A lot of customers are asking for the product, and that is where he or she wants to expand the business. There are two opportunities. There are actually three opportunities, but right now, on a more conventional way, we will talk only about two opportunities. First is taking a loan from, say, institutions or banks. The benefit of taking the loan is the ownership remains with the founder or owner. However, the limitations are limited funds can only be raised, and then the owner or that business has to pay interest at the fixed regular interval. There is another way uh, to get the funding. and that is to partly give away the equity or the ownership of that business to a common man or institutions, depending upon where from where they are raising the funding, right? So that is a shared ownership model, and with this there is actually no limitation in terms of raising the funding, so a huge amount of fund can be raised for business expansion. Also, another benefit is in the loan case, that owner has to pay a fixed amount of interest, right? However, as the ownership is getting diluted in case of the equity model, the profits are usually shared, right? Loss being shared. Yeah. Sorry, what did you say? I didn't hear you. कोणती स्क्रीन दिसते? गुगल मीट? अच्छा, अपडेट नाही झाली का ती? बाकीच्यांनाही ऋतुजा तुला पण गुगल मीट दिसते? हो. Okay. Let me stop presenting and start again. Sorry, I think I was on a different screen. Now, can you see the slide? Okay, good. Good. Okay. Yeah. So, yeah, so I talked about the agenda, so I won't repeat the agenda. The important slide was stock and equity, right? So I was talking about two different approaches in terms of raising the funding, uh, bank loan or institutional loans, or diluting the equity or giving away the equity. There is another way of raising the funding. Those are seed funding, right? If there is a startup, they can approach to venture capitalists, usually call it those are called as VC, and then initially raise funds, and eventually, if they still require after some time a big enough funding, then they kind of go on the equity model, that is called as initial public offering or IPOs. And then once those IPOs get listed, uh, then those are traded, and eventually that kind of ends up having the equity model, right? So I discussed about the benefits and drawbacks of both these models. Now, when we are trading, or if anyone is trading the equity, right, there are different types of risk associated. Many people would have seen with these mutual funds, right? Equity has a risk associated with it. There are different components of risk. First one is interest rate risk, right? So if your business or the organization in which you have invested, or the stock in which you have invested, if it has taken some funding from the bank, or say if you have invested into a share of a bank, and if RBI changes the interest rates, the that would eventually impact on the business of the bank as well, or on the business from which has taken a loan from the bank. And that risk, the investor has to consider before investing. If that person is a long term investor, usually they analyze the interest rate risk. The commodity risk is if the company in which you are investing is a manufacturing based company, and they require a raw material that is usually called as a commodity. If there is a price fluctuation in the raw material, they cannot uh, at that instance only transfer that increased price to the customers, right? So sometimes they have to bear this cost and eventually transfer to the cost. The reason might be customer might move to the another product, right? So that is the commodity risk. Currency risk is something like, say if the company is dealing with imports and exports. A typical example would be information technology or software companies. If there is a dollar fluctuation, it would impact on their balance sheet. and that is the currency risk. And country risk is if some company is heavily um, transacting with a particular country, and in that, if that country has changes in the regulations. A recent example would be the tariff war which is going on, right? And most of the countries are uh, kind of facing challenges because of the US restriction or US changes in the tariff war. Some countries have their own retaliatory tariffs which are going on. So all of these could impact on the businesses on at the global level, and that risk has also to be factored in. And these risks usually traders n- not always factor in those risks, but there are some scenarios where traders are cautious, right? As an example, if there is a RBI policy coming up, and those RBI policies are usually with some frequency. It could be on a quarterly basis or monthly basis, or the RBI usually reviews their rate of interests, and they align with, say, with inflation or GDP data, rate of interest of the whole banking system in India, right? So, if someone is holding uh, or doing any trading in the banking stocks, that individual would exit or reduce the position on the banking stocks if there is a RBI policy coming up, depending upon his or her own views, right? And that is where the risk analysis has to be done. So these are all the different risks which usually traders consider while doing the trading. Then we talked about the Indian market, right? So if in India any person has to own, say, a share or mutual fund, particularly the share, that person has to have a demat account. A few years back, even, give me a moment, I think someone has logged in. Okay. Yeah, so each individual who wants to have the share with them, they have to have it into as in the digital format, and the account that individual has to own is the demat account. It is similar to what we have a savings account into bank, right? Only difference is from that account you can buy the shares or and sell the shares. That is the different. And then there are different depositories which we talked about, CDSL and NSDL. The market timings are usually 5 working days, Monday till Friday. There are three different sessions, but the most important session is between 9:15, the normal trading session, which is shown here. Normal trading session, which is 9:15 until 3:30 p.m. That is where majority of the trading activities are done. There is a pre-open market session, 9 to 9:15. The intention of this session is to stabilize or uh, reduce the volatility once the market opens. There is a post closing session between 3:40 to 4 p.m. And then um, between 4 to 9, from 4 evening until 9 of the next, uh, 9 in the morning of the next day, there could be orders placed. Those are called as post market orders. However, the challenge with those orders are those orders do not usually get filled if you have a very particular price that you are asking for. It depends upon the availability of sellers and buyers, and that is also called as a liquidity into the market. So there is a less amount of liquidity into the market between 4 to 9, 4 p.m. until 9 a.m. However, the most liquid sessions are from 9:15 until 3:30 p.m. We have multiple stock exchanges in India. Two biggest stock exchanges in India are Bombay Stock Exchange and National Stock Exchange. Both of them are located in Mumbai. All right. So when we say the market has gone up or market has gone down, right? So in that market there are multiple stocks, right? Around 3,000 stocks in NSE, around 5,000 stocks in NSE. Out of those 3,000 stocks, few hundred or few thousand stocks might rally, might go up, few and remaining stocks might go down. Now the question is how to define whether market has gone up or down, right? So uh, in India, there are two indices. One is called as Nifty 50, which is from the National Stock Exchange, and another is Sensex. So you usually hear in the news or on the TV channels that Nifty has gone up or Sensex has gone up. Um, and these two are major indices. There are multiple different indices. As an example, there is a bank index, Nifty Bank Index. There is mid cap index. There is small cap index. However, these two are the biggest index, and usually people refer or a layman refers to Nifty 50 and Sensex as an index. Uh, the index constitutes of the biggest 50 companies in case of Nifty 50, right? And those are the top 50 companies from multiple sectors. It could be bank or oil and gas, and all of the different sectors. Top 50 companies are selected, and these companies are changed depending upon their performance or their market capitalization. That is also called as, many times called as, a free float market. The benefit of having index is it gives a pulse how the markets or how the country is performing. That gives an information. Many a times you would have seen mutual funds also compare, or some traders also compare their trading performance or mutual funds performance with these indices. Few mutual funds would say that our benchmark index is Nifty 50. That means uh, they will compare. In a simple hypothetical example, if say Nifty 50 index goes up by 10% within a month, and that mutual fund goes up by 11%, then the mutual fund would say that we have beaten the index by 1%, because there is a delta of 1% in this case, right? And usually it is compared, and that is why it is called as a benchmarking. People do trading on these indices. So um, this comes in the futures and options segment, in the into derivative segment. So I will cover that into the next sessions about trading. But keep in mind that the indices could be traded, and then bigger HNI clients or high net worth individuals who have a very big large portfolio into multiple crores, they their portfolio is hedged. They usually hedge those portfolio using the indices. Again, it comes in futures and options, so I will cover what exactly is hedging, how people do portfolio hedging, and how people trade the futures and options segments as well in the upcoming slides. But keep in mind that these are the benefits or usage of these indices. Any questions until this? Any confusion? All right. So next important thing, and this is where I think the technical um, analysis would start. So until that, it is all basic fundamental. What exactly is share market? What is the operating timings? What are the indices and all those basic things, right? So um, we have multiple ways of evaluating the stock performance. They could, if we plot the price of a particular stock at a fixed interval on the XY graph, there could be multiple ways of plotting it. It could be a line chart, yeah, and there could be another different ways, or bar charts, or different ways. One of the most standard way which people use is called as a candlestick chart. Candlestick chart is a Japanese way of representing the data. And there are two different kind of candles. One is a bullish candle, where usually if you open a charting tool or charting software, it will show a green candle and a red candle. Green candle means the stock has moved up during that time frame. It has uh, a wick, so upper wick and a lower wick, and there is a body, right? So whatever is in the body, it shows the difference from opening to closing. So it has opened at the bottom, or not at exactly at the bottom, but at the body's bottom, and closed at the body's top. That is where the closure was. During that time frame, it could have fallen down and then moved up and then eventually closed somewhere in between, right? So all of that has been captured with these lows and highs. So a lower wick indicates from opening it has dropped, then eventually gone up until the upper wick, and then eventually closed at the body end. So a bullish candle would be a green candle. Exactly opposite is the bearish candle. So it has opened at the top, so O is top, closed at relatively bottom, and then it has in between gone up and down, and all of that has been captured and shown as high and low. Usually people talk this as HLOC, right? So high, low, opening, and close price. So these are the two types of candles. Give me a moment. Oh, it is not updating at your end. Slide. How come? Hold on a minute. Pirutuja is saying me that the slide is not getting updated. Are you guys? Did you guys see the updated slide with the candlestick pattern? Now you are at risk, right? But okay, this is strange. Okay, okay. Now can you see the anatomy of candle stick? Yes. Okay. All right. Oh, this is strange. It is not updating, right? So I have covered index. Hold on. Yeah. So Indian market basics. Uh, what is the index? And then anatomy of the candlestick. I will quickly cover. It has high. If you could follow my cursor, it has a highest most price, lowest most price, the opening price, and closing price. And please keep in mind that the time frame can be different, right? So for this candle, it could be a 5 minutes candle, it could be a 1 minute candle, it could be few seconds candle, or a daily candle, 1 day's candle. It could be a weekly or monthly candle as well, depending upon how what time frame you want to select. Any question on candlestick? No. Okay. So there are, as I mentioned, multiple types of candlesticks, but these are usually the most popular or famous one. The first one is called as a Marubozu candle. It could be either a complete body of green, a complete body of red. What does it mean? It means the price opened at the bottom, and the bulls or the buyers and bulls are usually one and the same thing. So bulls or buyers kept on buying for this whole time period. So if it is a 5 minutes of candle, for this whole 5 minutes they kept on buying, and they did not allow the price to fall, and eventually closed at the top, right? This candle is perhaps the most strong candle in terms of identifying how the market is behaving. If it is still not updating, huh? Are you guys seeing candlestick patterns slide, or it is the anatomy of candlestick? Ah, okay, hold on. Stop presenting. If I share entire screen, share slide. Okay, I have now changed the shared settings. Okay, all right. So I hope you are able to see the single candlestick pattern, and I was talking about the leftmost Marubozu candle. The green candle I was explaining, the price started opened at, say, uh, scenario is 5 minutes. This is a, suppose this is a 5 minutes candle, right? And it opens at 100 rupees at 9:20 in the morning, and this is 105 rupees. So what has happened in that 5 minutes from 9:20 to 9:25? It opened at 100 rupees, and buyers kept on buying from 100 to 101, 2, 3, 4, and 5. And at 105, uh, it was a complete 5 minutes. That 5 minute got completed, and this candle closed. What does it mean? It means that during this whole time period of 5 minutes, buyers were only buying this stock, and there is a positive momentum in this stock. That means by considering this Marubozu candle, there is a high likelihood or high probability that the next candle or in the upcoming time, the price would move up. The same exactly opposite scenario in this red candle, right? So it opened, say, at 105 rupees, and then sellers or bears kept on selling this stock. So there were less buyers and bigger sellers, and they kept on selling from 105 until 100 rupees, and then at 100 rupees it closed. This means there is a bearish sentiment in this stock, and price might continue falling down. This is perhaps the most important candle. Again, when you are looking at this kind of candlestick, keep in mind that you have to also consider how the previous candles were, right? If the previous candles are way smaller and suddenly this big candle appears, there is a high likelihood that the trend would continue in that direction. Another is called as a spinning top. These are relatively smaller candles compared to this, right? Spinning tops and doji, right? These are smaller candles. Spinning tops usually are called as pause candles. So if there is a green candle and after that this small green candle appears, right? There is a high likelihood that it would continue. Okay, stopped. Can you see my screen? My God, this is all challenging session. Rutuja is saying that she is not able to see it. Yes, exactly. Okay, all right, then I will continue. Okay, so spinning top, if a spinning top appears after this Marubozu candle, right, whether it is red or green, it really doesn't matter. Usually green, if after green, there is a high likelihood that the pattern would continue or the trend would continue. Another call pattern or another candlestick is doji. This is an indecisive candle. This candle indicates that neither bulls or buyers or sellers or bears, they are sure about the price movement, right? So bulls tried to push the price high but then failed. Then bears tried to push the price low but then failed, and eventually it closed somewhere at the middle, right? So there is an indecisiveness. The price is in the equilibrium in in a simple term. It really doesn't matter what is the color of doji, because the body is usually very small or non-existent. Doji candle is supposed to be either the price would continue the trend or reverse. So there is a 50-50 chance with the doji pattern. There is a paper umbrella pattern. It depends how you call it, as a hammer or inverted hammer, right? So there is a body at the top and then a big wick. In case of green candle, what has happened, the price opened at this low, then bears or sellers tried to push this price at the bottom, but then eventually buyers came in and they started buying and eventually pushed this price higher. So this is a kind of positive sign that the buyers are winning this contest, and even the exactly opposite is this red paper umbrella. So if there is a downtrend, and I'm sure I have few examples. Let me switch to the, yeah. uh, if there is a downtrend and this paper umbrella, green paper umbrella, appears at the bottom, so there are some red candles which are appearing, the price is moving down, and suddenly at the bottom you see a paper umbrella, this green candle, there is an indication that the price would reverse, and either the uh, price will go into the sideways, right? So the price might not go up but might not fall as well, or there could be an absolute reversal, the price might go start going upwards. So that is the indication of this paper umbrella. So a trader would put a buy order just above, say, 1 rupee above this high price. If it gets triggered, he would start trading it, and the stop loss would be just below this bottom of the week. That would be one of the trade, and then however the price goes, he would start trailing for booking the profit. There are multiple. Okay, let me put this slide. And any questions on this? Marubozu, spinning top, or umbrella and doji? Okay. There are multiple candlesticks. So what we have seen earlier is a single candlestick pattern. We have two or sometimes three candlesticks which are appearing into sequence, and then people take trades on those. So first one is engulfing, right? Um, so what we see on this left hand side, this is called as a bullish engulfing. So price was falling down. This arrow indicates that the price was falling down. There was a small spinning top like candle formed, and then a big green candle which was formed, which engulfed the body as well as the week of the previous candle, right? So this is a relatively larger green candle. This indicates that there would there would be a reversal in the price, right? So a trader would place a buy order above this week, 1 point or 1 rupee above this week, and put a stop loss below this week, right? So if the price starts going up, as soon as it goes above this week, he would be in the trade. And if the price starts falling, uh, once it goes below this week, uh, this would be a confirmation that the bullish engulfing has failed, and then he would get out or exit from that trade by looking by taking a small loss. Same pattern, if there is an uptrend, if there is a small spinning top forming at the top and a big red candle after that, this shows that there would be a reversal from uptrend to downtrend. Another candlestick pattern called as harami, and again the harami candlestick pattern is a kind of reversal of the engulfing, right? So in this case there is a big bearish candle which is being generated, and then for on the small same time frame there is a small candle, which is the surprising news for bears is, number one, it closed at this point, the bearish candle. However, bulls kind of opened it above this price, right? And then they kept on buying and sustained this price. So it gives a big surprise to the bears, and they will start exiting their short positions. Short positions means selling positions, right? So in technical analysis, or in a trading verbiage, buying is called as a long position. If a trader is expecting the price to go up and taking a position or buying a stock, he or she would say that I am long on this stock. If a trader is thinking that the stock would go down or index would go down, and my view is bearish, uh, then in that case that trader would say that I am short on this stock or on that index. So buying means long and selling means short. Okay. Uh, the third pattern is called as a piercing pattern. Again, a downtrend, a big red candle, bearish candle, and then the price opens at the bottom, below the closing, right? So that is a good news for sellers, those who are selling and earning profit, right? However, bulls came in and then they started pushing the price up, and this price usually goes beyond 50% of this red candle. uh, if it goes beyond the 50% of this red candle and closes there, this is called as a piercing pattern. The opposite is the dark cloud. The price was going, or the trend was up, and eventually it kind of opened up compared to the previous close, and then base started selling, or seller started selling, and then around 50% they were able to push that price. This means there is a high likelihood or high probability that the trend would reverse. In this case, in case of bullish piercing, the trend would reverse and from downtrend to uptrend. The trade that could be taken is the 1 point above this high. uh, a trader can place a buy order, and stop loss would be just below this week, the lowest of this price, just below this week. And then depending upon how the price action moves, he would start trading the taking the profits. These are the reversal patterns.